Usually when we talk about a medical diagnosis, there's this expectation of just absolute precision.
Right, like an objective reality.
Exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points at it and says, yep, broken.
It's clean, it's binary.
Yeah, and honestly, it's comforting. But then you pivot away from medicine and step into the world of finance, specifically like the architecture of capital markets.
And suddenly that x-ray machine is, well, utterly useless.
Right. We step into a world that promises this mathematical x-ray level precision with all its formulas and models. But fundamentally, it deals with the ultimate chaos of human behavior.
And the unpredictable nature of the future, which you just can't put on a chart perfectly.
Which is why we're here today. I'm talking about portfolio management. This is the absolute cornerstone of any MBA finance curriculum.
It really is the bedrock.
So, welcome to the deep dive. We are going to serve as your ultimate audio study guide for this incredibly dense topic. I know reading chapter 12 of a finance textbook can be a little dry.
A little. I mean, it's brutal sometimes.
Fair enough. It's brutal. So our mission today is to extract the underlying mechanics of portfolio management and translate them. Not just the formulas you need to memorize for the exam, but the actual philosophy of risk that drives them.
And it is a critical shift in perspective for you as an MBA student. When you transition from studying basic corporate finance to portfolio management, you have to stop looking at a single company in isolation.
You start looking at the entire ecosystem, right?
Exactly. And, in places like India, this isn't just an academic exercise anymore. It has become a massive, highly regulated industry.
Because retail investors have just flooded into mutual funds.
They have. Which means you legally require a SEBI license, that's the Securities and Exchange Board of India, to practice this professionally. You are taking on a literal fiduciary duty to manage risk for other people.
And that fiduciary duty starts with a very specific operational definition for your exam. Portfolio management is the continuous process of deciding what investments to buy, hold, or sell.
You're managing a basket of securities.
Right, to manage that basket. And the singular objective here is to yield the highest possible return while absorbing the lowest possible risk.
Which sounds incredibly simple until you realize that return and risk are, well, they're inextricably linked.
They are glued together.
They really are. The entire discipline is about finding the optimal tension between those two forces. And to master this for your test, you have to understand the 5 distinct phases of the portfolio management life cycle.
Let's lay out the roadmap so you know exactly where we're going. Phase 1 is security analysis, 2 is portfolio analysis, 3 is portfolio selection.
Then you have phase 4, which is portfolio revision.
And finally, phase 5, portfolio evaluation. So let's pull apart that first phase.
Security analysis.
Yeah. Because
Okay.
before you can build the architecture of a portfolio, you have to understand the structural integrity of the individual bricks you're using.
And the sheer scale of the materials available is just staggering. I mean, we are looking at a universe of over 7,008 companies listed on stock exchanges in India alone.
That is a massive universe to sort through.
It is. So it requires a rigorous taxonomy to make sense of it. Traditionally, you classify these securities into 2 broad camps.
Okay, what's the first camp?
First, on an ownership basis, you have equity shares and preference shares. With these, you are literally buying a fractional piece of the company's equity. You are an owner.
Right. And the second camp?
Second, on a creditorship basis, you have debentures and bonds. In this scenario, you are not an owner, you are a lender. You're acting as a creditor to the corporation or the government.
So it's ownership versus creditorship. But modern financial markets don't just stop at traditional stocks and bonds anymore, do they?
Oh, not at all. Financial engineering has created an entirely new layer of complex instruments.
And as an MBA student, you have to know the mechanics of these innovative securities, not just their names. Like, let's talk about the mechanical difference between a deep discount bond and a zero coupon bond.
The mechanism is what really matters here. A traditional bond pays you a periodic interest rate, a coupon, every single year until it matures.
Like clockwork.
Exactly. But a zero coupon bond, well, as the name implies, pays absolutely zero interest along the way.
Wait, then how do you make any money?
Instead of interest, you buy it at a massive discount to its face value. So you might pay $60 today for a bond that guarantees to pay you $100 in 10 years.
Ah, I see. So the return is entirely baked into that capital appreciation at the very end.
Exactly. Deep discount bonds operate on a very similar principle of heavy initial discounts rather than, periodic yield.
But why would an investor actually want that? Like, why give up that regular cash flow?
Often it's for tax efficiency or something called duration matching.
Duration match.
Yeah. If you know you need a specific amount of money in exactly 10 years for a liability, a zero coupon bond eliminates reinvestment risk.
Which is the risk that you won't be able to reinvest those annual interest payments at a good rate.
Precisely. It locks it in.
Okay, that makes sense. Then the source material talks about flexi bonds and floating rate bonds. Those seem designed to solve a totally different kind of problem
They do. They solve the problem of interest rate volatility.
because interest rates are constantly moving.
Right. If you buy a traditional fixed rate bond paying 5% and suddenly inflation spikes and new bonds are paying 8%, the value of your 5% bond just plummets.
Nobody wants your 5% bond anymore.
Right. So floating rate bonds fix this by having variable interest rates tied to a benchmark, like a central bank rate.
So if market rates go up, your bond's payout goes up with it.
Exactly. It protects your capital.
Got it. And the final category of these complex bricks involves crossing borders, things like euro currency bonds, global depository receipts, or GDRs and ADRs, American depository receipts.
These are vital tools for a modern portfolio manager. Let's say you are an American investor who wants exposure to an Indian tech giant.
But you probably don't want to deal with the regulatory hurdles of opening a foreign brokerage account.
No, it's a nightmare. Or the friction of constant currency conversion.
Yeah.
So an ADR is a certificate issued by a U.S. bank that represents shares in that foreign stock.
Oh, so it trades in U.S. dollars on a U.S. exchange.
Yes. It offers seamless global diversification without all those logistical headaches.
So you have this massive toolkit, 7,000 domestic equities, zero coupon bonds, ADRs, but the ultimate goal of security analysis is just the golden rule of trading, right?
Buy low, sell high. Identify underpriced assets to buy and overpriced assets to sell.
But the methodologies for actually doing this represent a massive fundamental philosophical divide in finance. You have fundamental analysis, technical analysis, and the efficient market hypothesis.
Right, let's break those down. Fundamental analysis is the domain of Warren Buffett.
The classic value investing approach.
Exactly. It involves tearing apart a company's financial statements, projecting future cash flows, assessing the management team, and calculating an intrinsic value.
So if the true intrinsic value is $100 and the stock is currently trading at $80, it's underpriced.
Right, so you buy it. Now, technical analysis is completely different. It completely ignores the balance sheet.
Really?
Yeah. Yes. It assumes all fundamentals are already priced in. So instead, it looks purely at historical price charts, trading volume, and market psychology.
So they're looking for recurring patterns to predict future price movements.
Exactly. Chartists, they're often called.
Okay, I understand how those two operate. But the third approach, the efficient market hypothesis, or EMH, it kind of seems to completely invalidate both of them.
It definitely tries to. EMH argues that financial markets are incredibly efficient information processing machines.
It assumes that the current market price of any security already perfectly reflects every single piece of available public and private information.
The logical conclusion of EMH is that the market value of a security is always equal to its intrinsic value. Always.
Okay, let's unpack this. Wait,
Okay.
if we assume the market is perfectly efficient and market value always equals intrinsic value, then the entire concept of security analysis is just a total waste of time.
Yes, that is the implication.
Because you can never find an underpriced stock, because there are no underpriced stocks. Everything is perfectly priced at all times.
And that is the profound paradox at the heart of modern finance. EMH asserts that because thousands of highly intelligent analysts are constantly scouring the market for mispriced assets, they immediately buy undervalued stocks.
And short the overvalued one.
Right. And their collective aggressive trading forces the price to its perfectly efficient level almost instantly.
It's like I like to use a grocery store scale analogy. The efficient market hypothesis basically dictates that the scale in the produce aisle is universally, flawlessly calibrated.
Flawless.
Right. If you put an apple on it and the digital readout says 100 grams, that apple weighs exactly 100 grams down to the atomic level. There's no point in trying to outsmart the scale.
But fundamental and technical analysts operate under the belief that the store scale is occasionally broken, or at least, slow to update.
Yeah, they do their analysis, look at the 100-gram readout and say, well, my model shows this actually weighs 120 grams. The market is wrong. I'm buying.
And this creates a fascinating debate that you'll definitely need to know for your exam. If the EMH proponents are correct that the scale is never broken, then actively managing a portfolio to beat the market is mathematically impossible over the long run.
You should just buy a broad index fund and accept the market average.
Exactly. But fundamental analysts point to things like the 2008 financial crisis or sudden flash crashes.
Because those massive dislocations suggest the market is actually prone to bouts of severe irrational inefficiency.
Right. The scale definitely breaks sometimes.
So as a portfolio manager, you have to decide where you stand on that spectrum. But let's assume you've done your analysis, whether it's fundamental or technical, and you've identified your absolute favorite, highest conviction stock.
The one you are absolutely certain is vastly underpriced.
Right. This brings us to a conceptual bridge, phase 2. If you have found the perfect stock, why not put 100% of your capital into it? Why do we even bother building a portfolio at all?
Because of the inherent limitations of our own predictive power. You might be perfectly right about the company's financials, but you cannot predict external shocks.
So this introduces the two core principles of portfolio construction, the notion of diversification and the notion of negative correlation. Let's look at diversification first.
It's built around neutralizing a very specific type of danger called unsystematic risk.
Okay, for the exam, students really need to understand the difference between systematic and unsystematic risk.
It is essential to delineate between the two. Systematic risk is the risk inherent to the entire market. Think inflation, interest rate hikes, global conflicts.
You cannot diversify that away. A rising tide lifts all boats, and a tsunami sinks them all.
Exactly. Unsystematic risk, however, also known as idiosyncratic risk, is specific to a single company or a specific industry.
Like the CEO gets caught in a massive fraud scandal.
Right, or a key factory burns down, or a competitor launches a disruptive patent.
So if you put all your money into that single perfect stock and their factory burns down, you are just wiped out. But diversification operates on the mathematical premise that as you add more loosely related securities to your portfolio, the unsystematic risk approaches zero. A scandal at one company is just a blip if it only represents 2% of your total holdings.
However, and this is a big however, merely buying 50 different tech stocks does not constitute true diversification.
Because if the entire technology sector experiences a downturn, all 50 of those stocks will plummet simultaneously.
Right. And this is where the second principle, the notion of negative correlation, becomes the true driver of risk reduction.
Correlation basically measures how two assets move in relation to each other, right?
Yes, positive correlation means they move together. Negative correlation means when one goes up, the other tends to go down.
So the objective is to assemble a basket of securities that are negatively correlated as much as possible.
Exactly. By doing this, the variance, which is the wild, unpredictable swings in the overall value of your portfolio, is minimized. A loss in one asset class is fundamentally offset by a gain in another.
Think of a playground seesaw. As a portfolio manager, your objective isn't to launch someone into the stratosphere. Your objective is to keep the seesaw perfectly level, providing a smooth, stable ride.
I like that analogy.
Yeah. If you pick two stocks that are highly positively correlated, say an airline stock and a cruise line stock, it's like putting two heavyweights on the exact same side of the seesaw.
Because when a global travel restriction hits, both stocks crash.
Exactly. And your portfolio violently slams into the dirt. You haven't reduced risk at all, you've compounded it.
Conversely, if you find negatively correlated assets, perhaps an airline stock and a teleconferencing software company, you put one on the left side of the seesaw and one on the right.
So when travel shuts down, the airline drops, but the teleconferencing software surges.
The forces offset each other. The center of the seesaw, representing your aggregate portfolio value, remains balanced.
The theory is elegant. But how do we actually measure the seesaw? This transitions us into phase 3, the quantitative heart of the discipline, portfolio analysis. We need to move from the abstract concept of correlation to the mathematical measurement of risk.
Right, this is where the math gets heavy.
So grab your mental calculators. First, measuring the expected return of a portfolio is actually pretty straightforward.
It is simply the weighted average of the expected returns of the individual securities. So, if you allocate 60% of your capital to an asset expected to return 10% and 40% to an asset expected to return 5%, your portfolio's expected return is just the sum of those weighted values.
It's just simple proportions. The real complexity arises when we try to measure the expected risk.
Because risk in modern finance is defined by variance and standard deviation. Essentially, how wildly the actual returns might deviate from your expected average.
But we can't just calculate the weighted average of the individual risks, can we?
No, we have to mathematically account for how these assets interact. We have to quantify your seesaw.
And this requires a statistical tool known as covariance.
Covariance measures the interactive risk between two securities. It tells us the directional relationship between their price movements.
Let's explain the mechanism of covariance without just reciting the textbook arithmetic. At its core, covariance looks at how security A behaves relative to its own historical average, and simultaneously looks at how security B behaves relative to its own average.
Precisely. Suppose security A usually returns 10% and security B usually returns 8%.
Okay.
If, in a given year, security A has a phenomenal year and returns 15%, we ask, what did security B do in that exact same year?
And if security B also had a great year and returned 12%, they are moving together.
Exactly. If they consistently act up at the same time and crash at the same time, the covariance calculation yields a large positive number. They are positively correlated.
But if security A has a terrible year and drops below its average, and in that exact same environment, security B thrives and surges above its average, the mathematical product of those opposing deviations creates a negative number.
And a negative covariance is the absolute holy grail for a portfolio manager.
Because it provides empirical statistical proof that these two assets move in opposite directions, which inherently reduces the aggregate variance of the portfolio.
Let's actually walk through illustration 1 from the source text just to make sure this sticks for the exam.
Yes, let's do that. So we have security X and security Y.
Right. Security X has a mean return of 16 over a 4-year period. Security Y has a mean return of 12.
Okay, so 16 and 12 are our baselines.
Yes. In year 1, security X actually returns 12.
So that's a deviation of -4 from its mean of 16.
Exactly. And in that same year 1, security Y returns 18.
Which is a deviation of +6 from its mean of 12.
Now, multiply those two deviations together. -4 times +6.
That gives you a product of -24.
Right. Now, fast forward to year 4, security X returns 20.
So a +4 deviation.
And security Y returns 7.
A -5 deviation. So +4 times -5 gives a product of -20.
You do this for all 4 years, sum up those products, and in the illustration, the sum is -50.
And the formula says to divide that sum by n, the number of observations. So -50 divided by 4 years.
Give you a covariance of -12.5.
Boom. A negative covariance.
Yeah.
So these two securities are a great pairing for risk reduction.
Exactly. They move opposite to each other.
But covariance just gives us the direction. The raw number, like -12.5, can be difficult to interpret across different asset classes. To standardize this, we use the coefficient of correlation, denoted by the letter R.
The coefficient of correlation strips away the absolute volatility and isolates the pure relationship, and it is strictly bounded.
Bounded between what?
The value will always fall between -1 and +1.
All right.
A +1 indicates perfect positive correlation. They move in absolute lockstep. A -1 indicates perfect negative correlation, the flawless seesaw.
And a correlation of 0.
That implies the movements are entirely independent. Knowing what asset A did tells you absolutely nothing about what asset B will do.
This brings us to what is arguably the most intimidating formula in an MBA finance curriculum: the variance of a two-asset portfolio.
It looks terrifying on the page.
It really does. When you look at it in a textbook, it's this massive string of Greek letters and superscripts. But the underlying architecture of the formula is actually quite intuitive if you just break it down.
The formula for portfolio variance requires you to square the weight of the first asset and multiply it by its variance. Then you do the exact same for the second asset.
And then you add a third term that incorporates the correlation between the two. Here's where it gets really interesting. Let's use a culinary analogy to make this stick for the exam.
Okay, let's hear it.
Think of building a two-asset portfolio like baking a two-layer cake. The formula starts with the first layer of the cake, the isolated risk of security A, adjusted for how much money you put into it.
That's the weight squared times the variance of A.
Right. The second layer of the cake is the isolated risk of security B, also weighted. Now, if these two assets had absolutely zero correlation, if they existed in separate universes, the total risk of your portfolio would simply be the risk of layer 1 plus the risk of layer 2.
But financial assets do not exist in vacuums. They interact. They share the same macroeconomic environment.
And that interaction is the third part of the equation. It's the interactive frosting that binds the two layers together. That mathematical term, which is 2 times the weight of A times the weight of B times the covariance.
Or the correlation coefficient times their standard deviations, yes.
Exactly. That interactive frosting determines the final structural integrity of the cake. If the correlation coefficient is a positive number, that interactive frosting actually adds more overall risk to the structure. The cake becomes heavier, more unstable.
But if the correlation coefficient is negative, the entire interactive term becomes a negative number.
Mathematically, it subtracts from the total variance.
The frosting literally eats away at the inherent risk of the two individual layers.
I love that. This formula is the mathematical proof of why diversification works. It proves that combining two highly volatile assets can actually create a portfolio that is less volatile than either asset on its own, provided they are negatively correlated.
It's beautiful math, and once you understand how to calculate expected return and portfolio variance, you possess the tools to evaluate any combination of assets.
But the sheer number of combinations is infinite. Like, how do you decide which specific combination to actually execute?
Which shifts us into phase 4, portfolio selection and the revolutionary framework developed by Harry Markowitz.
Right. In 1952, Markowitz published a paper that essentially birthed modern portfolio theory. Before Markowitz, people largely focused on just picking individual winning stocks.
Markowitz formalized the math, showing that the portfolio as a whole is more important than the sum of its individual parts.
He introduced the concept of the portfolio opportunity set.
Yes. Imagine plotting every single possible combination of the thousands of available securities on a massive graph. The horizontal axis represents risk, measured by standard deviation. The vertical axis represents expected return.
Okay, so every dot is a different portfolio.
Exactly. This creates a dense cloud of dots representing millions of possible portfolios.
To navigate this cloud, Markowitz applied a deeply rational filter called the dominance principle.
And the dominance principle is built on two simple axioms of human behavior. Investors are inherently risk-averse, and investors prefer more wealth to less.
So the rules of dominance are absolute. Rule 1. If you are evaluating two portfolios that carry the exact same level of risk, you must choose the one with the higher expected return.
Makes sense.
Rule 2. If two portfolios offer the exact same expected return, you must choose the one with a lower risk.
It sounds obvious, but applying it mathematically clears out all the noise. Let's look at the efficient portfolio table example from the source text.
Perfect. So let's compare Portfolio 5 and Portfolio 6.
Portfolio 5 has a return of 13% and a risk of 11.3. Portfolio 6 also has a return of 13%, but its risk is 12.8.
So same return, but Portfolio 5 has lower risk.
Therefore, Portfolio 5 dominates Portfolio 6. You completely discard Portfolio 6. It is mathematically inefficient.
Let's do another one. Portfolio 3 has a return of 9% and a risk of 7.8. Portfolio 4 has a return of 11% and the same risk of 7.8.
Because they have the same risk, but Portfolio 4 has a higher return, Portfolio 4 dominates, discard Portfolio 3.
By systematically applying the dominance principle against every single dot in that massive opportunity set, you eliminate all the inefficient portfolios.
And what remains is a distinct boundary line along the upper left edge of the cloud. This boundary is known as the efficient frontier.
I like to frame the efficient frontier as a visual representation of maximum optimization. Think of it as a rigid, mathematical force field pushing upwards and leftwards on the graph.
You want your portfolio to be pushed as high up for maximum return and as far left for minimal risk as the physical limits of the market will allow.
Every single point resting exactly on the curve of that force field is an optimal portfolio.
Right. They offer the maximum possible return for that specific level of risk. Portfolios lying on the far right of the curve represent aggressive, high-risk, high-return strategies. Portfolios on the far left represent conservative, low-risk, low-return strategies.
But what about the space underneath the force field?
Any portfolio that lies below the efficient frontier is suboptimal. You are inherently accepting a bad deal.
You're leaving money on the table.
Exactly. You are either taking on excess risk without being compensated for it, or you are sacrificing potential return for absolutely no reduction in risk. A rational investor should never hold a portfolio below the frontier.
And there it is, the assumption of the rational investor. This is perhaps the most heavily tested concept on any MBA portfolio management exam. You have to contrast the theoretical assumptions of the Markowitz model with its real-world limitations.
It's a classic essay question. The math is flawless, but the inputs are fundamentally flawed.
Let's unpack the assumptions. Markowitz's model rests on several precarious ones.
First, it assumes that asset returns are normally distributed, that they follow a perfect bell curve. Second, it assumes that all investors are purely rational and universally optimized for the dominance principle.
And third, it assumes that investors can borrow or lend an unlimited amount of capital at a risk-free interest rate. Let's challenge those assumptions because market reality just shatters them. First, asset returns do not follow a perfect bell curve. They exhibit fat tails.
Right. This means that extreme events, massive market crashes like 2008, or sudden euphoric bubbles happen far more frequently than a normal distribution model predicts.
The assumption of absolute rationality is even more problematic. Behavioral finance has proven definitively that human beings are deeply irrational when money is involved.
We are driven by fear, greed, and cognitive biases. I mean, many investors erroneously believe that simply taking on higher risk guarantees a higher return, leading them to aggressively overpay for highly volatile assets.
Yeah, they totally ignore the dominance principle. And that third assumption, unlimited borrowing, that's practically absurd.
Oh, completely. Institutional hedge funds might be able to borrow massive sums near the risk-free rate, but a retail investor or even a mid-sized mutual fund faces significant borrowing constraints and much higher interest rates.
You cannot just infinitely leverage your portfolio in the real world.
This tension is critical for your exam. The efficient frontier is a brilliant analytical tool, a map of how the market should theoretically function. But it is not the actual territory. Real-world friction constantly distorts the frontier.
Now, within this theoretical framework, there is one specific portfolio that holds a special status: the market portfolio.
Yes. The market portfolio is the ultimate culmination of diversification. It is a theoretical portfolio that holds every single traded security available in the entire market.
And they are held in exact proportion to their overall market capitalization.
Right. If a massive technology company represents 5% of the total value of the global stock market, then exactly 5% of the market portfolio consists of that company's stock.
Holding the market portfolio means you have entirely diversified away all unsystematic risk.
The only risk remaining is the systematic risk of the market itself. In equilibrium models, the market portfolio sits at the exact tangent point of the optimal capital market line.
All right, let's say you've navigated the theories, calculated the covariances, respected the efficient frontier, and constructed an optimal portfolio. The job isn't over, is it?
Not even close.
Because a portfolio is not a static monument. It is a living organism. This brings us to phase 5, portfolio revision.
The necessity of revision stems from the dynamic nature of both the market and the investor. The risk profile of your assets will change over time.
Right, a stable blue-chip utility company might unexpectedly acquire a volatile tech startup, drastically altering its risk metrics.
Furthermore, the investor's objectives change. As a client approaches retirement, their tolerance for volatility decreases, necessitating a shift from growth-oriented equities to income-generating bonds.
So, portfolio revision is the physical act of changing the mix of securities. You are buying and selling to realign the portfolio with its objectives.
And there are two fundamentally different philosophies for doing this: portfolio rebalancing and portfolio upgrading.
Let's use an automotive analogy. Rebalancing is like taking your car in for routine maintenance, an oil change, a tire rotation. You aren't trying to make the car faster, you are just trying to keep it running at its baseline specifications.
That's a great way to think of it. There are several policies for rebalancing. The most passive is the buy and hold policy, which essentially involves doing nothing and letting the portfolio drift.
Just ignoring it.
Yeah. But a more active approach is the constant mix policy.
Constant mix is fascinating because it forces discipline. If your target allocation is 60% stocks and 40% bonds, and suddenly a massive bull market causes your stocks to surge in value,
they might now represent 75% of your portfolio.
Right, so a constant mix policy forces you to sell those outperforming stocks and use the proceeds to buy more bonds, bringing the ratio strictly back to 60-40.
It mathematically forces you to sell high and buy low. It counteracts the emotional urge to keep riding the winning assets until they inevitably crash.
But then there's a third rebalancing policy mentioned in the curriculum: portfolio insurance. And honestly, the mechanics of portfolio insurance seem to contradict everything we just discussed about selling high and buying low.
It does feel backwards at first. Portfolio insurance is a highly specific defensive strategy, often implemented using derivatives, but the underlying concept is crucial.
The primary objective is to establish a hard floor, right?
Yeah.
A minimum portfolio value that you refuse to breach, regardless of how bad the market gets.
Exactly. The mechanics dictate that as the portfolio's value rises, you actually buy more risky assets like stocks.
Buy more as it gets more expensive.
Yes. But as the portfolio's value falls and approaches your predetermined floor, you aggressively sell stocks and move the capital into risk-free assets like treasury bills.
It feels incredibly counterintuitive because you are selling assets as their price drops. You're selling low.
But remember the objective. You aren't trying to maximize long-term wealth here. You are trying to guarantee survival. If the market is crashing toward your floor, selling stocks and buying cash guarantees, you won't crash through it. If the market is rising, the distance between your current value and your floor increases. You have a larger safety buffer, which means you can mathematically afford to take on more equity risk.
Okay, that makes sense. That's routine maintenance. The other method of revision is portfolio upgrading. If rebalancing is an oil change, upgrading is completely tearing out the engine and swapping it for a new one.
Upgrading involves fundamentally reassessing the intrinsic value of the securities you hold. If your analysis indicates that a stock you hold has become drastically overpriced relative to its fundamentals, you sell it.
You then hunt for newly underpriced securities to replace it.
It sounds ideal. Constantly weed out the overvalued and harvest the undervalued.
But the curriculum notes a severe practical limitation here. Investors and managers are highly reluctant to engage in constant upgrading. Why? Because swapping an engine is incredibly expensive.
Upgrading introduces massive friction in the form of transaction costs. Every time you buy or sell a security, you pay broker commissions. You suffer the bid-ask spread.
And most importantly, if you sell an asset that is appreciated in value, you trigger a capital gains tax event.
Those taxes and fees act as a constant drag on the portfolio. You might identify a trade that mathematically improves your expected return by 1%, but if the transaction costs and taxes eat up 2% of your capital, the upgrade actually destroys wealth.
Which is exactly why high-turnover active management often struggles to beat passive low-turnover index funds over a long horizon.
Which perfectly transitions us to the final phase of the life cycle, Phase 6. You've analyzed, selected, and revised. A year has passed. Now the client wants to know how you actually did.
This is portfolio evaluation, the report card. But we need to draw a hard line here between performance measurement and performance evaluation for the exam.
Performance measurement is purely observational. It is the raw, absolute return of the portfolio. If you started with $1 million and ended with $1.1 million, your measurement is a 10% return.
But a raw 10% return is completely meaningless in a vacuum. If the overall market went up 20%, your 10% return is actually a massive failure.
Right. Furthermore, measurement tells us nothing about the risk taken to achieve it.
This is where performance evaluation comes in. Evaluation contextualizes the return. It compares the return against an appropriate benchmark, and crucially, it adjusts the return based on the specific risk profile of the portfolio.
To understand risk-adjusted returns, we have to start with the baseline, the risk-free rate.
The risk-free rate is the theoretical return you can earn on an investment that carries zero risk of default, typically represented by short-term government treasury bills.
If the government is paying 5% on a treasury bill, you are guaranteed 5% just for breathing.
Therefore, any return you generate above that 5% is your reward for actively taking on risk. We call that excess return the risk premium.
So if your portfolio returns 12% and the risk-free rate is 5%, your risk premium is 7%.
The fundamental question of portfolio evaluation is, how efficiently did the manager use risk to generate that premium? To answer this, the financial industry relies on three foundational models: the Sharpe ratio, the Trainer ratio, and Jensen's alpha.
These three metrics are the holy trinity of portfolio evaluation. You must know these for the exam. Let's dissect the Sharpe ratio first, developed by Nobel laureate William Sharpe. It is referred to as the reward to variability ratio.
Here's the ultimate mnemonic for the exam. Sharpe uses standard deviation, S&S.
That's a great tip. The math for the Sharpe ratio is elegant. The numerator is your risk premium, the actual return of the portfolio minus the risk-free rate.
And the denominator is the standard deviation of the portfolio's returns.
So you're taking the excess return and dividing it by the total volatility of the portfolio.
Exactly, total volatility. Because standard deviation captures both systematic market risk and unsystematic company-specific risk. It measures the absolute variability of the entire ride.
Now let's look at the Trainer ratio, developed by Jack Trainer. It is known as the reward to volatility ratio.
The numerator is exactly the same as Sharpe, the portfolio's return minus the risk-free rate. But the denominator changes completely. Instead of dividing by standard deviation, you divide by the portfolio's beta.
This is a profound difference. Beta does not measure total risk. Beta measures only systematic risk, how sensitive the portfolio is to the overarching movements of the broader market.
Right. A beta of 1 means the portfolio moves exactly with the market. A beta of 1.5 means it is 50% more volatile than the market.
Beta completely ignores unsystematic risk. It assumes the manager has already diversified all of that away.
So Sharpe divides by standard deviation, Trainer divides by beta. Let me offer a video game analogy to help visualize why a manager might look good under one metric but terrible under the other.
Please do.
Imagine you are navigating a deeply challenging level in a video game, and your final score is your risk premium. The Sharpe ratio judges your performance based on how many total times you got hit by absolutely anything in the game.
Okay, so total damage.
Yeah. It counts the minor minions, the environmental hazards, and the big boss fights. It is a measure of your total, overall, sloppy gameplay. That's standard deviation.
And Trainer.
The Trainer ratio evaluates you differently. It assumes that getting hit by minor minions is a failure of your basic setup, a failure to diversify.
Right.
Trainer doesn't even count those minion hits.
Interesting.
Trainer only judges you on how efficiently you handle the massive, unavoidable boss fights that every player is forced to face. That unavoidable market volatility is your beta.
That analogy perfectly illustrates the mechanical difference. If a portfolio manager generates a solid return, but does so by taking massive, concentrated bets on just 2 or 3 highly volatile stocks, their standard deviation will be enormous because they failed to diversify away the minion hits.
Consequently, their Sharpe ratio will be abysmal.
But if those specific stocks happen to have a low correlation with the overall market, the portfolio's beta might actually be quite low. So that exact same manager might show a relatively strong Trainer ratio because Trainer is blind to the concentrated unsystematic risk they recklessly took.
Let's actually look at illustration 3 from the text to cement this.
Okay, we have a risk-free rate of 8%. The market index, called MAX, has a 21% return, a standard deviation of 25, and naturally a beta of 1.2 in this example.
Then we have Fund Ace, return 14%, standard dev 15, beta 0.6, and Fund Joy, return 16%, standard dev 22, beta 1.5.
When you calculate the Sharpe ratio, subtracting the 8% risk-free rate and dividing by standard dev, Fund Ace scores a 0.4, Fund Joy scores 0.36.
And the market index, MAX, scores 0.52. So under Sharpe, MAX wins. Fund Joy is actually worse than the market.
But look at the Trainer results, dividing by beta instead. Fund Ace scores 10, Fund Joy scores 5.33, and Max scores 10.83.
Wait, let me recalculate the Trainer for Ace. 14 minus 8 is 6. 6 divided by 0.6 is, the text says Ace is 0.67.
Actually, if you look closely at the textbook's math, there might be a typo in the illustration's final output, but the concept stands. Max generally wins the Trainer ratio here at 10.83, meaning the market itself was the most efficient user of systematic risk.
This is why institutional allocators demand both metrics. Sharpe tells you if the manager is providing a smooth overall ride. Trainer tells you if the manager is generating sufficient return for the specific market exposure they are taking.
Which brings us to the third and final evaluation metric. Differential return, universally known as Jensen's alpha, developed by Michael Jensen. Alpha is the ultimate scorecard for an active portfolio manager.
To calculate alpha, we first have to determine what the portfolio should have earned, theoretically, based on its risk profile.
We use the capital asset pricing model, or CAPM, to establish this baseline expectation.
CAPM is another absolute pillar of modern finance. It dictates that the expected return of any asset is equal to the risk-free rate, plus the asset's beta multiplied by the equity risk premium.
And the equity risk premium is simply the expected return of the overall market minus the risk-free rate.
In plain English, CAPM uses beta to tell you exactly how much return the market owes you for the amount of systematic risk you took.
If the market is up 10% and your portfolio has a beta of 1.2, CAPM calculates the mathematically required return you must achieve to justify that elevated risk.
Let's say CAPM calculates that based on your high beta, you should have achieved a 12% return. That is your baseline. Jensen's alpha is simply the difference between what CAPM said you should have earned and what you actually earned.
So if your actual return was 14%, but CAPM expected 12%, you generate a positive alpha of 2%.
That positive 2% is not luck. It is empirical proof of managerial skill. It proves that during Phase 1, security analysis, the manager successfully identified genuinely underpriced securities, or during Phase 4, accurately timed market upgrades.
Positive alpha is literal value creation.
Conversely, if your actual return was 10%, but CAPM expected 12%, you have a negative alpha of 2%.
You took on risk, but your stock picking destroyed value relative to what a passive index fund with the same beta would have achieved.
And with alpha, the life cycle is complete. You analyze the pieces, you measure their covariance, you select the optimal frontier, you rebalance against the friction of the market, and you evaluate your skill by hunting for alpha. We have navigated the entire architecture of portfolio management.
It is a complex ecosystem, but breaking it down into these 5 distinct sequential phases provides a logical scaffolding that makes the entire discipline comprehensible for the exam.
Exactly. As we wrap up this deep dive, I want to step back from the formulas for a moment. We have spent an hour constructing these incredibly elegant, mathematically rigorous models: covariances, CAPM, efficient frontiers.
They are beautiful constructs. They really are.
They are. But remember, the limitation we discussed with Markowitz: all of this beautiful math is fundamentally predicated on the assumption of rationality. It assumes that market participants will systematically act to optimize their utility.
But the reality is that the market is not a machine. It is a vast, interconnected network of human beings.
And human beings are inherently emotional, susceptible to panic, driven by greed, and demonstrably irrational in times of stress.
Exactly.
So here's the final thought I want you to mull over as you close your notes and prepare for this exam. Are we utilizing perfectly structured, flawless mathematics to accurately measure the market? Or are we just using perfect math to place a comforting grid over absolute, unpredictable human chaos?
The next time you look at a wildly fluctuating stock ticker, ask yourself, are you looking at a standard deviation or are you looking at raw human psychology?
A perfectly calibrated scale, or a broken one? It is the question that defines the industry.
Keep that tension in mind.
Master the math, but respect the chaos. Good luck with your studies, and crush that exam.